What's up, millennials? In exchange for about 10 minutes of your time, today we're going to look at a company called Indie, and that is a semiconductor company that is going to be acquired by the SPAC under the name Thunder Bridge Acquisition, so far trading under the ticker symbol THBR. Before we start, a few things first. First of all, I have not done extensive research. I'm just going to look at the valuation according to the company and the SPAC themselves. Number 2, don't trust me, verify me. I'm just a random dude on the internet, just documenting my journey, not a financial advisor, so don't trust me, always verify me. And third, stock o'clock. These are very short 1-minute videos that I post every single trading day with news about the stock market. Alright, first of all, I'm going to do a very short introduction of this company, of Indie. So as I've said, this is a semiconductor company, and they are, I liked this very much, in pursuit of the uncrashable car. Because their solutions, of course, make it so safe. They also provide some software solutions. We're actually going to take a look at some of those. Over here we can see a few of their solutions and multiple applications for their solutions. And these are all related to vehicles, right? Mainly autonomous vehicles. First of all, you see that they are focusing on autonomous driving, also on connected cars, so it could be like a small 5G play here as well. On the user interface within the cars, and also electrification of the cars. Here you have an overview of their solutions. I'm not going to talk about them, but if you want to check them out, then you can pause the video for a second. But right now we're just going to go ahead with the pro forma valuation. So basically, like all the other SPACs out there, they start with a base share price of $10 per share. And they, after the merger, are going to have 144.7 million shares outstanding. That means we can already do something. We can take the share price of $10 per share and multiply it by the amount of outstanding shares after the merger. And then we're going to get a market cap or an equity value. So if we do that, if we take $10, the price per share, multiply that by the amount of outstanding shares, we're going to get a market cap of almost $1.5 billion. Then we also see that they are going to have $465 million in cash on their balance sheet. So then we can say, okay, the market cap is $1.447 billion. If we subtract the amount of net cash, $465 million, we're going to arrive at an enterprise value of $982 million as well, which is the same number that's presented over here in the investor presentation. But if we go into TradingView, we can see that the current price of this SPAC is $12.70. So $12.70. That means a few things. That means that now the equity, the market cap equity value has gone up to $1.8 billion. And the enterprise valuation has gone up to about $1.4 billion. The next thing that we want to know is the future enterprise valuation. How do we do that? We need two things for that. First of all, we need their EBITDA of a certain year, and we need a EBITDA multiple. Let's first take a look at their EBITDA numbers. Okay, of course, these are predicted EBITDA numbers. No one knows for sure what kind of EBITDA, what kind of revenue, what kind of gross profit they're going to have in the future. So these are all guesses, all estimates. Keep that in mind, okay? That's very important. Okay, here you have the row of EBITDA, and here you have the years. Let's go to 2025. So the last year they have predictions for. If you then look down, they say that they predict to have an EBITDA of $154 million. Okay, $154 million. Keep that number in your mind, 154. Let's go back. So we now have the EBITDA of 2025, which is $154 million. And now we need an EBITDA multiple. And they said, okay, we are going to compare ourselves with some similar companies, some other semiconductor companies. You see them all here, Cree, Ambarella, etc., etc. And they say, okay, these companies, we've looked at their enterprise values and we've looked at their 2022 EBITDA numbers. And they are trading at a median EBITDA multiple of 32.4x. Okay, 32.4x. Okay, they also said, well, we've also looked at the auto tech SPAC companies. In this case, Luminar, Velodyne, and EVA. And they, if you look at their enterprise value and their 2025 EBITDA, it's 15.7x. So you see a few differences. Here they're talking about a 2025 EBITDA. Here they're talking about a 2022 EBITDA. So I'm not entirely sure if this comparison is exactly fair, but hey, we're going to roll with these numbers, okay? So they say, okay, 32.4x, 15.7x, cool. We are going to give ourselves a range of 25 to 30x. Okay, sounds kind of fair if you take into account the other numbers we've just been looking at. All right, so now we have an EBITDA of 154 million, and they apply a range of EBITDA multiples of 25x to 30x. Let's first go with the low EBITDA multiple to arrive at a future low valuation, right? So we take that EBITDA of 154 million and we multiply it by 25. Is about $3.9 billion. It's slightly different from the number that's in the investor presentation. I suppose that's because the EBITDA number is not exactly 154 million, but it's probably like 154.4 million or something like that, right? So we're just going to use the numbers from the investor presentation in the future in a second. Okay, so that is the low multiple. And then if you take the high multiple, you're going to arrive at about $4.6 billion. Cool. So I've put these numbers in my Excel spreadsheet. For the low end, we have $3.861 billion taken from the investor presentation. And for the high valuation, $4.634 billion. That means that we have now a midpoint valuation, so basically the average of these two numbers, of $4.247 billion. Okay, so that is a midpoint fair valuation for the future, for 2025. So now we can take that future valuation to arrive at a discounted current enterprise valuation. How do we do that? Well, we take those future valuations and we apply a certain formula to that. First of all, we need to know two things first. We need to know a discount rate, and we need to know the amount of years we're going to need to discount it back. Okay. First of all, the discount rate. As we can see in the investor presentation, they use a discount rate of 20%, which is very similar to other SPAC valuation videos that I've done. It's almost always 20%. Okay. Then we also need the amount of years to calculate it back, to discount it back. Well, we've been looking at the EBITDA numbers of 2025, right? And here is where I think Indy and the SPAC made a mistake. And I'm not entirely sure, but I think they made a mistake. Because they said, we're going to look at EBITDA numbers of 2025, right? Right now we're living in 2021. So I think that would suggest that we need to take it back, discount it back 4 years in time, right? But they only calculated it back 3 years in time. So it might be a mistake, not 100% sure, might be a mistake. Anyways, let's do it on my method and see what the difference is going to be exactly, right? First of all, we're going to take that future enterprise valuation. Let's start with the low one, $3.861 billion, right? In 2025, cool. Now we're going to apply a formula. First of all, we're going to divide it by 1.2, the 2 here standing for the 20% discount rate. And we do that to the power of 4. I believe it's 4 because from 2025 to 2021, right? And that is going to give us a valuation of 1.86 more or less billion dollars. As you can see, there's a difference of about like $350 million between my valuation and their valuation. So I think for now, I'm just going to stick to my valuation until until I'm certain that I made a mistake and not they. But yeah, for now, I'm going to stick with these numbers. And that's also what my Excel sheet is calculating for me. So the low valuation discounted back to the current, to the present, is about $1.86 billion. If we do that for the high valuation as well, so that's 4.634, as we can see here on the left-hand side of the investor presentation. And we apply exactly the same formula, so we divide it by 1.2, because of the 20% discount rate again, to the power of 4, again, I think is 4, but okay. And that is going to give us a high valuation of $2.23 billion. And again, you can see a difference of about $450 million over there. And again, if we look into my Excel sheet, you can see again that same number of $2.234 billion. And then if you take these numbers, these two numbers, and then calculate the midpoint valuation, you're going to arrive at a valuation of a little bit more than $2 billion. Now we just need to do one more thing, because right now we already have these enterprise valuations, right? But we need to know a few more things. First of all, we need to know the fair market cap, okay? How do we do that? Well, at the beginning of this video, we said, well, to arrive at an enterprise value, we take the market cap and deduct the amount of net cash. So to now arrive at a market cap from the enterprise valuation, we take the enterprise valuation and we add the amount of net cash, right? So if you do that for the low, mid, and high valuation, you're going to arrive at a low market cap of 2.3 billion, a midpoint market cap of 2.5 billion, and a high market cap of 2.7 billion. Now you can do something else. You can say, okay, these are the market caps. We know the amount of outstanding shares, 144.7 million. So now we can take these market caps and we can divide these market caps by the amount of outstanding shares. Okay? So that means that you're going to arrive at a price per share with a low valuation of $16.08. For the high valuation, $18.66. And for the midpoint valuation, $17.37. Keep in mind a few things. First of all, we did a slightly different calculation than the SPAC and then the company. So the number from the company would be a little bit higher, just a little bit, not too much, but a little bit higher. And also keep into account that these are the numbers right after the merger happens, okay? So right after the merger happens, they're going to have 144.7 million shares outstanding, and then they are going to have these valuations, and then the fair price per share would be these numbers over here. So there you go. A midpoint fair price per share would be $17.37, which would indicate a growth of 37% based on the current price per share. However, as I said in the beginning, never trust me, always verify me. So check what I'm doing, check if that's actually correct. And also take into account that we have been taking a look at assumptions, right? We have been taking a look at a predicted EBITDA number, a certain EBITDA multiple, and if you change one of these numbers, then the entire calculation is going to change as well. So with that being said, thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye-bye. Bitcoin, please go to moon.